Okay, ladies and gentlemen, my brothers. I think I emphasized the singular yesterday. My apologies to my brothers, and of course my sisters, to the clergy at large. I don't need to remind you. I hope I don't need to remind you. We're here. What are we here for? More acid breathing. October the 7th, 2025. A Tuesday. A Tuesday after what felt like an epic Monday. The kind of Tuesday where the confetti is still stuck to your shoes. And the hangover, oh my God. Actually, I'm quite lucky. I don't really suffer too much from hangovers. I take my alcohol neat and without sugar. But it's one of those days where the hangover perhaps can't decide whether to become a migraine or a revelation. Let's hope it is the latter. Let's hope we can open the book of Revelations. Because these markets are pretending to be calm, but you can still smell the smoke. The smoke of what did they say? It's like the gums taste of aluminium. The panic, the exuberance. Was it a party? Were we? What was Prince? What did Paul Tudor Jones, named after a private jet? Prince party like it's 1999. Nines, decades, 1929, 1989, Japan, Tokyo, 1999, 2000, NASDAQ, 2029, 100 years after? Surely not. Let's see where a provocative curiosity can take us. It has to take us far away from today, however, because the government, that shoddy lot in Washington, yeah, and of course nationwide, they're still closed. Still closed. The accountants, the economists, the advisors, the do-gooders are on furlough, and there's now even question marks as to whether they will get back pay. Of course, that's a lot of people. I think, did I read 750,000 people presently suspended on leave, suspended full pay, you just can't touch it. And the data feed for the markets, disconnected, dead air. We don't have CPI. What is CPI? Inflation, consumer price inflation. We had no payrolls. Brought joy and happiness to my Friday. No construction spending. Today, the Atlanta Fed, we all love the Atlanta Fed. It has a nowcast. Did someone say stable? We don't know. It's a secret. They're closed for business presently. So the Fed is flying blind, which is just a polite way of saying we're all guessing, we're all hoping, we're all pretending. I am certainly going to try. I'm always nervous doing these things. Out of desperation is less and less scripted. Note to myself, it is 8:47. I mean, yesterday I spoke for almost an hour. But yeah, yesterday there was a lot going on. But I say nervous. So I'm writing without script. I've got a kind of few pointers which I'll move to. And then I'm going to have the audacity to try and think in real time. And yeah, I'm not going to be negative. It could be a car crash, or the great book of Revelations. Let's see. Revelations, but there's a certainty. Feds are cutting interest rates at the end of the month. And that's going to rhyme with what I'm going to go on and try and speak about. So let's try and get there. Market did nothing. Market was just whispering confessions from yesterday. The tech still the tech. Oh, banks, regional American banks, mating for survival, making love, jumping in bed, getting together. Currencies, there was nothing really. Gold and Bitcoin, they're all gold. Gold was $4,000, $4,009. There was even an article. in the Guardian. You know something's not right when you're reading about gold in the Guardian newspaper. And actually, I was my Substacker paper from a week ago, and just being conscious or trying to be conscious of the dopamine from networks, fanning to your prejudice. Um, I find the Guardian newspaper, the digital online, which I refuse to pay for, keeps asking me, it's like, we know you keep using it. Would you like to contribute? I'm like, no, I would not. Um, but it's very informative to read an online newspaper where it wears its prejudice so evidently on its sleeve, and that prejudice is not one you share, and it's it's like it's kind of like reading the code behind the script. Like when you do that copy paste and you drop it into your document, you're like, whoa, I'm an amazing writer, fib fib. Um, and that's not a confession. But whereas you drop it into a Google Docs, you can see like the Chat GPTs like um, claiming it. Hmm. Bank mergers. Let's talk about bank merger. Because there's always um, reminiscences. It would seem when I come to speak. Perhaps it's the late time. Perhaps it's because it's so close to my bedtime, and my bedtime is so early presently because this is rehabilitation. I'm Rocky Balboa. I'm in the gym every day. I'm running on the beach barefoot. Not every day. Um, I'm not drinking. I mean, big existential question. Do I want to drink again? The poison. Um, Question mark. And I'm trying to eat. I'm trying to eat before sunset. Now, once you start introducing a lot of ladies back onto the island of St. Bart's and friends and busy good times, what I want to say is social. How am I going to cope with that? And doing this. Anyway, I'm talking to myself. I'm doing this podcast, which is taking me 4 hours. Anyway, reminisces. The third bank. That is such a bad name. It must have just changed its name. I am not familiar with the fifth third bank. I mean, who wants to be fifth? Who wants to be third and fourth in the middle? And surely you want to be first to second, but maybe that actually is why there was a proposed merger with Comerica, $10.9 billion funded by equity. And two Midwestern banks becoming becoming the ninth largest banking entity in America. I mean, again, yawn, yawn, yawn. It's funny, the mind plays tricks, but I was assigned when I was working in Edinburgh as an investment analyst. And when did I start? I started in September 1990. My first year was Japan. We may talk about Japan later. So that's, 2 years. Did I do 2 years or 1 year? 1 year, I think, in UK equities, large cap. And then I got posted. I got asked to sit on the other side of the trading floor in the American department in 1993, 94. And the American equity department was the tiniest department. I had the smallest equity allocation. How things change, but I think it had no more than 3% of a global mandated for an equity for a UK based pension scheme with UK liabilities. So back then, as much as 50-60% of that pension fund would be in UK equities. Imagine how far that's fallen. And 3% in the US, and back then, probably 12% in Japan, 20% or so in Europe. I feel like the European proportions probably held steady. Everything else has changed dramatically. And I can recall writing passionate letters to the investment policy, to my elders, the investment policy committee saying, this is just nuts. Like, these are the best companies in the world. And we only have like 2.5%, 3%. Like, our US holding was less than a single stock UK concentrated holding. Yeah. I mean, it's a bit like, I think I read today that Taiwan Semiconductor, I think it's 12% of the emerging market index. And so that one stock is actually larger than several sovereign nation, their stock market representation in the index. And the American department was run by an old fuddy-duddy, a very old school, very gentlemanly, but I can't say scholarly. He was just kind of lucky, and very endearing and very charming. And because no one much cared about the US, he was put in charge of US equities, and I worked with him for a year or so. It was, interesting. I mean, what can I say? Didn't learn much. And then he retired, and a young up and coming thrusting partner from the UK equities came over and ran the shop, and I went on a trip to visit American companies. And a long story. Speed up, Hendry. But the new chief, he wanted to invest in Comerica. And Comerica is the company that's just been taken out, and they were headquartered in Detroit. I love the way the French call Detroit Detroit. It's like, tell me what? Detroit, or tais-toi is like, shut up. Detroit. Anyway, again, listen to yourself. And up until just like kind of doing some notes to speak to you now, I was incensed, because I was in love with, the pharmaceutical stocks, Merck, Pfizer, Coca-Cola, General Electric, Jack Welch. I mean, it was a universe of interstellar, amazing companies, Warren Buffett, and valuations which were modest, and yet apathy in the investment policy committee of Edinburgh. And they weren't idiots; they were smart people. And then I was asked to like present, and actually we bought a ton of Comerica, which was just plain boring. It was like, is that the best we could do? And I mean, the chief at the time, Mick, he was called Michael Bruce, lovely chap. And I think he had noticed that on the UK side, we'd done terribly well investing in Lloyd's Bank, and the equity returns had been phenomenal as the bank shrunk and contracted itself, and in doing so, the amount of capital it released for dividends and share repurchase really made it very hot. Something very similar happened, I want to say, was it in the 1980s in the oil sector, and stocks like BP were terrific when oil was not. And again, it was rather than pursuing growth with an immense capital investment, it did not, and therefore it became very cash generative and returned a great bounty to shareholders. Anyway, I can remember even to this day saying, being annoyed at that decision to own Comerica. And then I was looking at the chart, and Michael Bruce was like the majority of them at Baillie Gifford in Edinburgh. I look at quarterly data, price data, just because I can get the maximum, and I've been boring you or trying to inform you about the majesty of these very, very long compressed trading ranges with price ceilings, which are respected until 10, 15, 20, 25 years later. New punks come on the scene, bust it. They can see the future more clearly, more positively, and stocks take off. So I look at quarterly on my chart database, and I can see from mid 1994, if I count the quarters, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. What is that? 3 years. Every quarter, the Comerica price rose vis-a-vis the previous quarter. It went from, I don't know, $18 to $80. So I have to apologize mentally to my former boss. He did well, but I can remember being in Detroit or Detroit, and I can remember being absolutely bored to death about why we were there. And we didn't even, now with my macro head, why did it perform so well? Savings and loan crisis, was a couple of years before. You basically had a huge component of the competition. Savings and loans institutions just went to the wall. So you got to imagine that would be a beneficial time to be a large Midwestern bank. That is my story. I noticed that the commingled assets are going to be $212 billion. It's really, really small when you think of NVIDIA being a 4,000 billion market capitalization. So synergies, corporate pillow talk, all that nonsense. I think it's really a fear of dying small. These regional banks, they and us and everyone. What did I say 5 minutes ago? Rate cuts at the end of the month. Is priced in. It's a certainty, and we'll get more. And so the kind of easy funding, the last few years were good for banks, good for bank profitability, good for bank margins. That is going away. So it's certainly not a growth thing. It feels like Darwinism in a banking pinstripe suit, perhaps. What does that even mean? There are efficiency gains, but it's like, I think they're just putting off the inevitability of dying, which leads into, I think there were 3 prominent, for me, stories that stood out today. And I don't even know if this one was today, but Standard Chartered, a significant emerging market bank, particularly in Asia, listed in London. And they came out with a big report, and they're saying there's about $270 billion, which again would be kind of the combined size of the 9th largest bank in America, but about $270 billion already invested in stablecoin funds within their emerging market providence. And they think another $1 trillion is going to bleed out of the emerging market banking system and into stablecoins over the next 3 years. That is big. I want to say that US M2 is less than $20 trillion. So $1 trillion is like 5% of US money supply leaving emerging markets. And where's it coming? It's coming into the US. It's coming into to buy US treasuries. And that is a huge challenge for the local currency emerging market banking system. Money quietly migrating into what is that? The metaverse. American exceptionalism with an API. Two different software blocks talking to each other, communicating and transferring money. Dollars traveling without a visa. Everyone else requires a visa, not the dollar. Stablecoins, pegged to the dollar. No commercial risk. The offshore accounts of the everyman in Cairo, Karachi, Lagos, with your smartphone, the ubiquitous smartphone, your wallet, your digital wallet can be a lot more sound than the local bank branch of even Standard Chartered. Who needs armies when your power and your reach is seeping through the digital circuitry of the world? And just think of like the Europeans, the Brits. They're still like tying the whole thing up in regulation. A gilt stablecoin, yeah, doesn't have a great edge to it. A European stablecoin, well, which treasury is it? Is it the Italian BTP? Because the Germans, yes, they're going to spend a great deal more, print greater deficits, but there ain't a lot of boons presently. It's interesting, that story. And again, I'm teasing. I'm going to come. Oh, let's see if I can. But I'm hoping I can come back and tie that into some thoughts, some tired thoughts. I shouldn't say tired thoughts, should I? And the other one was Stellantis. The car company, a merger, I think, of Fiat and Chrysler. And it kind of sounds again like the marriage of convenience of Comerica and Fifth and Third. Doesn't it sound the same? Like that merger was a holding pattern, holding out as long as possible against the near certainty of extinction. And this is phase two, and this is a profound error. I believe this is a profound error. This is my opinion. But they're planning to spend $10 billion in the US reviving the Jeep and the Dodge brand. Those brands, one other, which I can't remember, account for 40% of the group profits. Yeah, corporate nostalgia, midlife crisis, but no, you cannot be serious. So 10 yards, the context of like a 30-yard market cap, $30 billion market cap. I think like $4 billion of debt in there. There is no reason to make conventional cars in North America, and most likely there's no profit to make electric powered vehicles in North America or anywhere else in the world, when there is one sovereign nation, mercantilist nation, willing to subsidize production of EVs and to have employment at the expense of corporate profitability domestically. China. This is a dire executive decision. Shame on them. If you look at the share price of Ford, GM, of any, apart from perhaps the Japanese, and again, that could demand an explanation if I can round it all up. But these are stock prices that go sideways, not for days, weeks, or months, but for decades. There is absolutely no profitability to be had. It's a crime, the amount of analytical attention they receive, the fact that we're even talking about it. But I think it's worthwhile discussing at this point, because it's just dramatically bad, and it's you just have to look at the share price. I mean the shares. No, what am I looking at? I've only got I guess with the corporate action, the combination of the European and the American businesses, our chart only goes back to 2020. The stock price peaked in March of last year at 28 and is presently around just under $11. I'm pretty sure if we had the standalone versions of Fiat or Chrysler, they'd be trading below where they were at the end of the 1980s. You cannot be investing $10 billion. I promise you will look back and you will see that probably led to the extinction of this automaker. Bum 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 bum. Drum roll, drum roll, drum roll. Right, now for the tricky part, winding all this together. And I'm going to try and do so under the headline, the Kobayashi test. And I'm going to read back to you, or try and share components of a long, not so long, but a thread that I wrote on X a month or so after the peaking of the Stellantis share price, but April or so, 2024. And I wrote that risk assets, stocks are on a tear. Let me interpret me. Stock prices are going up. I was noting that, there'd been a pullback. What did we discuss yesterday with Paul Tudor Jones? You are periodically going to have mean reversion points, typically to the 1 year. On at least one sort of pullback of that nature, at least every 18 months, I would argue. And then I was saying, but the huge global carry, which is is it an invention, or is it it's the synthetic manufacture of new dollars from borrowing depreciating yen and buying American or dollar-denominated risk assets. I was saying that's in its ascendancy, that everyone can't get enough of it. So that was, what am I saying? Global carry, borrowing, the creation of dollars. This is the euro-dollar system, funded out of Tokyo, where banks have not been interested, domestic banks have not been interested in domestic lending. But they generate a return by pledging, and this is supposition, asset supposition. They pledge their JGB overnight to, 3-month treasury bills to other counterpart banks across the world. And they receive dollars in return. And with those dollars, they then use that to then act as collateral to other intermediaries to buy. I haven't described that very well, but I'm not going to get stuck on that. But I'm talking about the creation of synthetic dollars via the securing of dollar collateral. So pawn shop, you take your JGBs in, and you take $1 billion worth of JGBs in, and the pawn shop guy gives you $1 billion of treasuries back, and then you're armed with this collateral, and then other institutions will print you dollars in return, and then you will lend those dollars to hedge funds and other financial speculators, who will buy things which are in their ascendancy. They will buy technology shares in the S&P. That's what I was trying to say. On Twitter, I think I used 35 words. And on my podcast, I think I spent 25 minutes. Anyway, I went on to say the Fed is trapped by American growth. That the fiscal spend from Uncle Joe Biden was kind of baked in, the stimulus from the pandemic. It's a known entity that would underwrite American GDP growth well into 2027. And a year and a bit later, that still feels, that resonates, that feels true. And so you got high risk, like cash risk-free American rates, much higher than the rest of the world. Flooding the world's capital markets, sending asset prices higher and higher. That hasn't changed. That's only continued. I was writing that the rest of the world needs lower rates. China is evidently struggling. Japan, strange place, but nominal GDP. Um, how greater is it today vis-a-vis the end of the 1980s? Is it 15? Must be more than 15%. It's probably 50%. Maybe I'll check that. But maybe it's 50%. Maybe I don't think it's more than. I don't think real GDP is more than 50% greater than it was at the end of 1989 in Japan. And Europe, I mean, oh my God. Europe, I'm really on a kind of a bit of a hate exercise just now with St. Bart's, just with workers and getting things done. This is the maintenance period. And there's just an appalling European sclerosis. My electrician, I'd ordered, I'd given him a deposit of about $3,000 to get plaques. These things. What is a plaque? Like an electric socket plate, and you'd be able to put in an American plug or a European plug. I gave him that order in mid-May. Here we are in October, and the intermediary, the supplier, has yet to supply the product, and kind of like smoking a cigar. Is like, yeah, I don't care. So I'm really hating Europe, but Europe needs lower rates. It would seem there's a sclerosis, and the ECB's listened to that, and rates have come down. I don't know. I've never understood the Bank of England. I think they're morons. I think they're all morons, but the Bank of England are really quite high, very high up in the pyramid of moronic behavior. And so I'm describing I'm describing a world where American GDP growth, America becomes the locomotive of economic growth, not China, certainly not Japan. And so it doesn't really need to reduce interest rates. It has a fiscal policy which is kind of mandated to be loose. Remember, I was writing this 18 months ago, and it's been made looser. So it doesn't really need lower interest rates. And so the higher rate of return on cash is sucking money out of the rest of the world. And of course, 12 months or so after this tweet, we started using the term American exceptionalism again. Capital markets outperforming. And I came to this piece, the Bank of Japan, and I like this. I said, Bank of Japan rate hikes. Back then, the expectation was really for quite a lot of rate hiking by the Bank of Japan. And I said, that is a con. That is made up. That is not going to happen. I don't know why I speak like that when I get emphatic. I wrote, Japan is trapped like the Bank of England. Morons! Jokers to the left of me. Idiots to the right. At least I'm not stuck in the middle of the Bank of England. But Bank of England trapped like they were in 1992. Evans, 1992. I don't know if that came across on the mic, but I just heard we got thunder rumbling. The yen rates today, in 2024, are comparable. When I say yen rates, that would be, I guess, expected 2-year forward, or 1-year forward, 2-year forward, yen kind of cash rates or 3-month rates. Were comparable to the Bank of England, stuck at 12% on the eve of Black Wednesday. And the now US Treasury Secretary and George and Stan um, doing the victory lap of Black Wednesday and Sterling's big slap in the face. So why was I making that comparison? I really like I made that comparison. Provocative, good hook. Japanese rates trapped like the Bank of England in 1992. And the reason, simple, possibly dull, but Japanese debt servicing. Now, okay, let me just complete my sentences. Because Japanese debt servicing already takes 1/3 of the government revenues. Actually, when I say 1/3, it's 1/3 of all Japanese expenditure, and all Japanese expenditure is greater than the tax revenues. So let me say that again, because Japanese debt servicing already takes 1/3 of government expenditures at zero rates. That requires, if there's anyone knowledgeable in the room, they would say, liar, liar, pants on fire. Japanese debt servicing, debt being, 2.5 times GDP, but zero rates, so as we're coming out of COVID. The interest servicing is more like between 7 and 9%, 7 and 9% of the total spend of the Japanese government. But when you include lack of rollover or like the redemption of bonds, that number is more like 27% of revenue, and they spend more than revenues, and so you get close to 30%. So 1/3 of government revenues on on total debt servicing and repayments on the outstanding debt stock. My goodness, I did go on there. And so I was talking about the Fed dilemma, which would be the Kobayashi test. Kobayashi, is this me writing pen pal love notes to my beloved in Japan, or is this me talking about a scene from Star Trek? The Fed dilemma. A need or a desire, question mark, to synchronize with the rest of the world and cut rates. So the need, the desire, the pursuit of synchronicity perhaps would be to kind of put the world's capital markets back into balance. The US being a locomotive for economic growth, you don't want it to be sucking in all of the world's capital and starving growth in the rest of the world, which kind of feels like the 1920s. And again, like the 1920s, Benjamin Strong being persuaded, hey, listen, if you can lower your interest rates, then that puts it makes it easier for the rest of the world to hold capital within their territory. And again, so let's go back to some of the points I mentioned earlier. The stablecoin, the best part of 300 billion US dollars has already left emerging market banking systems and gone into America, into dollar stablecoins. And here's one of the major banks that operates in these emerging markets, and it's saying next 3 years and another $1 trillion. And that's capital. That's kind of high-powered money. That's dollar collateral, treasury collateral coming in and feeding an economy which is not in recession. Just the data light has gone off for the moment with the shutdown. So you can see there's a temptation, hey, like Benjamin Strong, we should be cutting rates. But again, as I suggested earlier, the economy domestically, it needs rates to be higher than the rest of the world because the situation in America is just economically superior for the time being. And so to kind of, it's like a waterbed. Okay, if I sit down over here and I try and solve this kind of great influx of capital, which is asphyxiating growth in the rest of the world, And I don't need it. I don't need to steal it. I'm not China. I don't need to steal it. So maybe I can kind of push it back to where it came from by cutting my rates. But my domestic economy, I'd have to subjugate the domestic agenda. Domestically, we need 4, maybe we need 5, 5.5. So the dilemma is, if you do subjugate, empirically, the evidence is that US asset prices soar. Again, the Dow Jones, I think from 1914 to 1924, making these figures up, I could come back. This won't be a million miles away. The dates might be out by 3 years. And yes, we had a world war, but it took the Dow 10 years to double in price. Yes, there was a war, but wars bring on inflation. And yes, the market was closed for 3 or 4 years, but when they open it, you play catch up. 10 years to double. And yet, 2 years from 1927 to 1929, when domestic growth was subjugated to bail out the rest of the world, or to push back capital back, if you will, to the provinces of the American empire. The Dow doubled, and of course then toppled over in dramatic style at the end of 1929. So do something and cut, and asset prices soar. And then, and we had Paul Tudor Jones harking on about this. The melt up is what he was describing. This would be the origin source of the melt up. So I was writing about it 18 months ago, and Paul Tudor Jones was on television yesterday, and we're talking about the melt up. What's the opposite? You do nothing. And again, the ascendancy of that capital inflow still bids up your US prices. And it asphyxiates growth everywhere else. And eventually it will corrupt the singularity of the dollar via, profit warnings. And perhaps through a desperate over leveraging of stress that foreign entities. It was foreign entities that funded the curb lending. The Fed had been very good at pulling back domestic regulated American banks in 1929 from extending credit against the collateral of equity portfolios. The absolute expansion and mania in that collateral lending using stocks as the collateral was funded by overseas. So like when your economy is down on its luck, you take a lot of risk in the hot place. Anyway, so this was the notion of the Kobayashi Maru, the famous test. Captain Kirk. And think of Captain Kirk, I'm going to go on to this, being Trump, or Captain Besant, or Captain Poe, or think of all these characters on the Starship Enterprise. And they're presented with this no-win scenario. And in the movie, the Starfleet vessel is the Kobayashi Maru. I think Kobayashi is a famous Japanese behavioral scientist, I'm guessing. But the vessel is in distress. It's surrounded by enemy vessels, and all decisions lead to the inevitable. You're going to lose the Kobayashi Maru. The crew are doomed. Doomed, people. It's a no-win scenario. And Kirk, Kirk is an acid capitalist. And he's like, there's got to be a way. I'm an optimist. And of course, there's always the third option, the third eye. And the Fed needs a third option, a third eye, and maybe you got it. But there are no third options, I hear you say. Oh, wow, there was lightning. The third option, and Kirk goes for his cheat. Cheat. Anyway, the system, as Paul Tudor Jones has entered. I hope you hear the thunder. The system has entered the final countdown, the blow off to the top. We're there. Wow, I'm loving this. Okay, thought process. So what if the third option? So capital inflows, American exceptionalism, American stock market capitalization being just great, like a profoundly high level, say, versus the DAX, the S&P versus the DAX, right? You know, I mean, for sure, Apple or Nvidia, the market capitalization is greater than the capitalization of all German stocks. And if you maintain the dollar collateral, the risk-free rate, the cash rate at 4, is going to draw in capital from the rest of the world, and it's going to starve economic growth in the rest of the world. China, example, and create even more trade tension. So that's not good. You can cut interest rates, and kind of like Powell kind of did he pivot that way at the end of 24? Because did he do? What best part of a full percentage point or 75 basis points? What did he do? Did he do 50, 25, 25? And then did he have buyer's remorse? And he went, oh, in January of this year, it's like, oh, no more, no more, no more. Because very, very worried about that. The Dow doubling in 2 years from 1927 to 29. Very conscious of their history, the Fed heads. So what if you... Because there are elements, I cannot finish my sentences. There are elements of just what seems profound, dark, masterclass genius at the heart of the Trump administration when it comes to these economic affairs. And so what if you have pivoted to cutting rates closer to the rest of the world, despite the domestic economy not needing it? You have inherited kind of guaranteed fiscal expansion until kind of mid 2027, or thunder, rumble, rumble. What if you go for the tariffs and people are like, well, what are you doing? Tariffs, you're going to slow the economy. You're messing with spending decisions. And you're like, maybe you can do that. Why don't you create a potential turmoil? Why don't you handicap? That's a better saying. Why don't you handicap the American economy with the uncertainty and of the embrace of higher imported prices? Why don't you handicap an economy which is strong and set to be strong, knowing that the bozos, one way or the other, will, at the central bank, will normalize rates and bring them lower. So you have that. But at the same time, you're handicapping with kind of like a once-in-a-lifetime opportunity to reverse. You've got this mandate to... Okay, two things. Reverse what? Reverse the profound and awful decline in living standards of the average American. Mandate, well, you know, you were given an election college a mandate to pursue change. And tariffs are a means of doing so. And again, within tariffs, actually, you are expanding I love the tariffs. You're taxing the rest of the world. It's a tax. The US has expanded its tax franchise. It's now collected by every export into the US economy are paying taxes to their feudal lords, the Americans. And you're doing the digital thing at the same time, which is all part of the tariffs is all about the rejection of mercantilism. And mercantilism, the stain that was destroying the entrepreneurial culture and nature and genius of the American economy. It was sustained for almost 4 decades because it bribed you. It was a system that washed back all of its export dollars and bought you a risk-free rate and lowered interest rates, took the natural rate of interest rates and profits to zero, to a point where commercially outside the tech sector. There was no desire to invest. No desire to invest in capacity. No productivity. Declining real compensation. Ugly, horrible situation. So you've got tariffs pushing against that. They're a kind of hidden tax. Hidden? I don't know how hidden they are. You're increasing the tax franchise at a point where your debt is high and you need a solution. And you're doing so with an economy that can kind of bear it. Maybe we're set. Oh my God, my computer. My computer needs to be plugged in. Oh, is this a what happens next? Do I go and get my cable? Do I keep with my flow? Is my flow? I'm not going to ask questions. Are we on the point of saving the crew of the Kobayashi Maru? I'm going to have to pause. There was lightning there. There's going to be thunder. 1, 2, 3. Okay, this may be the last time you ever hear from me. I'm outdoors. I like doing outdoors. I like the projection of my voice. Outdoors, indoors is an echo. Outdoors is a rumble with thunder. There is a most phenomenal electric storm going on. My computer's now charging. It's sitting on the bar outside by the swimming pool. Is modestly raining. Oh my God, lightning. And I feel like my computer could be a conducting rod, so I better continue this and move on quickly. So, saving the crew of the Kobayashi Maru. I'm thinking, I keep Japan and topics. Finally, 25 years later, like the Dow exceeding the bubble high. It's the currency. You've had a 40% devaluation in the yen. And America has not protested. And so I think it's all part of this grand bargaining thing that I've been trying to think about to try and finish my substacking paper. Japan, well noted for the debt of 260% of GDP, less noted for the gigantic foreign reserve assets, which are predominantly treasuries. Japan, the sovereign, is the largest, I think, holder of US treasuries. And, wow, lightning. The, concentrate. Think of the capital gain from the tax deval on that. And then you had, Mashishota, what he was called, the SoftBank guy. And there's this notion of, again, the alliance between America and Japan. And it's like, let's use this reserve asset. I don't need you buying my treasuries because I'm over here and I'm about to suck $1 trillion out of emerging market banking systems. I want you to take Japan's sovereign balance sheet and not own treasuries, but kind of come up the risk deck. It's a bit like sovereign QE. We're moving people along the risk frontier. And I want you to take equity stakes as we role play, practice. We do armaments, rearmament. Are we in the 1930s and the enemy is China? And I'm going to give you equity stakes. I want you, as the sovereign, not investing in my treasuries, but investing in how we bring manufacturing onshore. And if you do that, I'm kind of going to look the other way. You can devalue. It's going to help. There's no other way you're going to get growth. And the more pressure I put on Powell, I'll get rates back down to zero. And so I'll give you this, the capital won't flee. I mean, it's not fleeing Japan anyway, but we'll stabilize and we'll stop asphyxiating the economic growth of everywhere except America, and we'll have it more geographically evenly spread, and that'll be good for you. Be fantastic for your corporate profits. That's what the stock market smells. And do you know what? It's the one thing the Chinese, we won't permit them to do it. And so it's a flank. We're using you. You actually are helping us take on and bring down the might of the Chinese mercantilist. That's what I'm thinking. I'm going to stop there before this electric storm blows me up. Forgive me. That was a controlled detonation of spontaneity. Paul Tudor Jones sees a melt up, and go back. Well, you won't find it, but April 2024. Well, I've read it out to you. I'll probably publish it again on X tomorrow. All of that just came to me today. And thankfully I woke up out of this torpor. I was feeling tired, but I'm feeling a lot better. And there is more. Do I want to do the more? Because the melt up. We're in the melt up. We're in the melt up. Oh, and again, in terms of being pro-cyclically good for Japan, I mean, I was so worried about it. I mean, it's Japanese banks funded all the money going into Thailand. So again, let's be provocative. America feels like the Asian tiger of Thailand in the 1990s, and Thailand was an economic miracle. In the 11 years, I don't know why I'm saying 11, but the 11 years of compound growth rate into the crisis of 1997, Thailand compounded its economic growth at, in real terms, of like the old style Japan at kind of 9% per annum. In the background, from various shocks, including Kobe earthquake, the yen had weakened from a profound high. It got to 80 versus the dollar. That's a profound high. It devalued. It slipped from 80 to 140. It's a profound move. Japanese banks, again, we're doing dollar carry, creating dollars, and supplying the risk capital that went into Thai stocks. And so you had dollar collateral, you were getting a return lending out your dollars that you were creating. And it was all against yen, which was losing value vis-a-vis the dollar. Genius until the melt up, like Icarus, got too close to the sun and collapsed. America, think about it. Think about America as Thailand, and we'll discuss it. Substackers send me messages, people listening on the podcast. It's called fan mail, but you can send comments. I'd appreciate that. There's a melt up. I don't know how long, but there's a melt up. I really must stop the lightning. It's getting so close, but there is a melt up, and the dollar weakens and weakens, and then it will blow. I've stopped talking to Reed. Yeah, I'm going to leave. I'm leaving. I promise you, honey. I'm leaving. Honey, I ain't coming back. I'm coming back tomorrow. I promise. The notion of crypto being marketed as a safe haven, I think, is one of the punchlines of the decade. I did note that the Bitcoin ETFs, 6 billion in a week. We're at 126,000. We're going to be at 200,000, 300,000. I think it goes to 1 million. And gold, 4,000. I saw 4,009. Any higher figures? What if there are actors smarter than the lot of us? I hope they exist. The Kobayashi Maru. I'm going to sleep on that. I'm going to listen to this a few times. Tell me your thoughts. No shipping. No Bay of Biscay. This has been acid breath. I feel like I've held my breath a long time. I have survived the thunder and lightning storm. No, I have. Again, bisous, French kisses from the French Caribbean to all of you wonderful folk. Share thoughts with me. And if I survive the night, I'll be back to discuss this more thoughts tomorrow. I hope you appreciate it. I don't have answers. I'm simply a provocateur. I'm trying to stir up the fascination, the curiosity. Collectively, we have answers. I am the fire starter. Good night. Good night. Good night.